Hello, my name is Anthony Danaher, President of Guild Investment Management. I'd like to share some of our thoughts on income investing in a rising interest rate environment. U.S. interest rates have been in a general state of decline since 1982, going to very low levels in the past couple of years as global economic growth has slowed and deflationary fears have kept cropping up. In Europe, interest rates have gone to absurdly low levels this year. In fact, they've actually been negative for many months in several countries. As investors, we want to be alert to trend changes. If rates change trend direction, what does that mean for income investments? In fact, the key for all income investors is determining when and how fast interest rates will climb. It could be that 2015 marks a pivot point for interest rates. Based on U.S. economics, we believe that the Federal Reserve should raise short-term interest rates in 2015. Now, it's possible that geopolitics could cause the Fed to defer their first rate increase in 9 years, but just analyzing U.S. economic activity with respect to employment, wages, prices, we expect the central bank will bring a new interest rate rising cycle. If over the next year or so you were to add 1 percentage point to the yield curve that is currently near zero for short-term interest rates or 3% for long-term bonds, you'd be at 1% at the short end and 4% at the long end. Those are still very low interest rates by historical standards. However, it's not just a function of adding 1 percentage point in interest rates. It's how investors in the markets extrapolate those and future moves. Interest rates don't need to go up a lot to do considerable damage to certain income investments. From such low current levels, a 1 percentage point move is a sizable move in the cost of funding. There's a tremendous amount of borrowed money that has been borrowing to buy income-paying investments. Every incremental rise in interest rates dramatically changes the overall expected rate of return on that levered portfolio. The fear of higher costs borrowing could start a large liquidation of investments in income-centric investments. But it's not just a function of the leverage investors that could cause damage to income portfolios. There's a lot of investor money that's been hiding in income-paying investments, seeking safety and shelter from market volatility. If rates start a prolonged rise, longer-term bonds and certain income vehicles are going to appear anything but safe. Most obviously at risk are longer-term bonds with fixed payouts. In general, all bonds, municipal bonds, junk bonds, bond funds, will lose attractiveness if rates are rising. Bonds, by definition, have fixed income streams. If you have to own bonds, because that's what your investment policy statement or what your mandate requires, we recommend selling longer-term bonds and shortening the maturities of your portfolio. Bond funds and bond ETFs, while they may offer attractive yields and may provide investors with diversification, they hide risks. These funds may hold a lot of illiquid, high-yield junk bonds or emerging market debt. If the underlying assets are not very liquid and bond funds start to get redemptions, you could start to see some disruptive trading activity and large declines in net asset value of the funds. Be careful of bond funds. There are much better options in a rising interest rate environment. However, we do caution that many of the favorites of income investors, like utilities, REITs, MLPs, and slow and steady dividend payers, may be more risky in the rising rate environment. Growth is the key. We're researching fast-growing companies that pay dividends and that will grow those dividends. Income investors should no longer focus on the dividend rate. They should look at the dividend growth rate. In a rising interest rate environment, investor capital will not favor slower growing dividend paying stocks or no growth high dividend paying investments. Growth needs to be the metric you use to select income investments, whether they're REITs, MLPs, utilities, or other income paying stocks. How fast the dividend payouts are increasing will be much more important to the future performance than the current dividend payout rates. Look for faster growing stocks that pay dividends, companies that are returning cash to investors by buying back their shares and steadily increasing dividends. These are the ones that we believe will outperform traditional income investments as rates are rising. Another income investment opportunity that we at Guild Investment like to utilize from time to time is short-term foreign government bonds. These can be very attractive for investors looking for income and appreciation. And we like to do the research on which currency and which country to own. And these can be a good way for income investors to diversify in a rising interest rate environment.